Have you ever wondered how the wealthy get richer using debt? This musing often leaves many baffled. We've grown up knowing debt as a dangerous pitfall to avoid. But what if I told you it's not always the villain it's made out to be? Indeed, debt can be a powerful tool in wealth creation. It's all about perspective. You see, the wealthy don't just view debt as a liability. They see it as leverage. They use it as a stepping stone to multiply their assets rather than a stumbling block. It's like a game of chess, where they strategically maneuver their financial decisions to checkmate wealth creation. So the paradox of debt is this. While it can lead some into a cycle of endless repayments, for others it opens doors to opportunities that expand their wealth. It may seem paradoxical, but many of the world's richest individuals have used debt to their advantage. One of the secrets to the wealthy's use of debt is leverage. Now you might wonder, what is leverage and how does it work? Picture yourself trying to lift a heavy object. It's a lot easier with a lever, isn't it? In the financial world, leverage operates much the same way. It's a strategy that allows you to multiply your assets using borrowed funds, just like a lever lets you lift a heavy object with less effort. Leverage is a powerful tool that the wealthy use to generate wealth. It involves using borrowed capital for an investment, with the expectation that the profit made will be greater than the interest payable. In essence, it's all about taking calculated risks to maximize returns. Now let's talk about how the wealthy use leverage to multiply their assets. Say, for instance, you have $100,000 to invest. You could put it all into one venture, or you could leverage it. By borrowing another $100,000, you now have $200,000 to invest. This means you've doubled your potential for returns, and this is exactly what the wealthy do. They use leverage to boost their investment power. But here's the catch. Just like a lever can make lifting easier, it can also make falling harder. If the investment doesn't pan out as expected, you could end up losing not just your original capital, but also the borrowed funds. This is why it's crucial to understand the risks involved and to use leverage judiciously. The wealthy understand this risk and have strategies in place to manage it. They diversify their investments, spread their risks, and ensure they have a safety net. This way, they can take advantage of the benefits of leverage while mitigating its potential downsides. In summary, leverage is a strategic tool that, when used correctly, can significantly amplify your wealth-building potential. It allows you to take calculated risks to maximize your returns, and the wealthy have mastered its use to multiply their assets. Leverage, when used correctly, can be a game changer. Real estate, a favorite among the wealthy, is an excellent example of leverage. It's like a game of Monopoly, but in real life. Here's how it works. You take on a mortgage, a form of debt, to purchase a property. This property then becomes an income-generating asset as you rent it out. The rental income you receive can not only cover your mortgage payments, but also leave you with a tidy profit each month. Over time, as you pay down your mortgage, you're essentially using someone else's money to increase your own wealth. And let's not forget, the value of your property could also appreciate, leading to even more profit when you decide to sell. This strategy of using borrowed money to invest in real estate has been a proven path to wealth accumulation. In fact, it has created countless millionaires. So investing in real estate with borrowed money isn't just a strategy, it's a wealth creation tool. Debt can be a catalyst for business growth. So let's delve into the world of business expansion. Imagine this. You're an entrepreneur with a successful venture. The demand for your product or service is high, and you're ready to take the next step to scale your business. But expansion requires capital, and that's where debt comes into play. Taking on a business loan can provide the necessary funds to hire more staff, invest in new technology, or open additional locations. It's a calculated risk, with the potential for increased profits far exceeding the cost of borrowing. This isn't reckless spending, it's strategic investment. And here's the beauty of it. As your business grows and profits rise, you're not only able to pay back the debt, but you're also building a more prosperous future for your business. It's a virtuous cycle, propelled by the power of debt. Business loans have fueled the growth of some of the world's most successful companies. Another way the wealthy use debt is by investing in the stock market. This strategy, known as leveraging, involves borrowing money to buy more stocks with the expectation of earning a return greater than the interest payable. It's a bit like using a magnifying glass to focus the sun's rays on a single point. It can either light a fire or burn your fingers. The stock market, with its potential for high returns, offers a glittering prospect for leveraging. But it's not all sunshine and roses. The market's volatility means that prices can plunge as well as soar, potentially leaving you with losses greater than your original investment. One must tread this path with caution, understanding that the potential for high returns comes with a side of high risk. It's a bit like sailing in stormy seas. The prospect of discovery and treasure is exciting, but the journey is fraught with peril. While risky, investing borrowed money in stocks can be highly lucrative. Investing in oneself is another way the wealthy use debt to their advantage. Imagine this: you take on a student loan to pursue higher education or specialized training. It might seem like a burden now, but think of it as sowing seeds for a bountiful harvest. You see, it's not just about a degree or a certificate, it's about acquiring skills and knowledge that set you apart. These valuable skills you gain can propel you into high-paying jobs or open doors to lucrative business opportunities. Yes, you'll have to repay that loan, but with a higher income, it becomes manageable. And the return on this investment? Well, it's not quantifiable. It's a lifelong asset that keeps on giving. You're not just borrowing money. You're leveraging debt to fuel your potential, to carve out a niche, to build a prosperous future. So remember, education can be a worthwhile investment, even if it means taking on some debt. Smart debt management is a key aspect of wealth creation. Now let's talk about debt consolidation. This is a strategy that involves rolling multiple high-interest debts into one lower-interest loan. Think of it as merging multiple payments into a single, more manageable and affordable monthly payment. Imagine you have several credit cards, all with high interest rates. Rather than paying each of these separately, you could take out a consolidation loan with a lower interest rate. This way, you pay off all those high-interest debts at once, and then you only have the consolidation loan to worry about. This not only simplifies your finances, but can also save you a significant amount of money over time. You're effectively reducing the amount of interest you're paying, which means more of your money is going towards paying off the principal debt. Remember, the ultimate goal here isn't just to make debt easier to handle. Debt consolidation can make debt more manageable and less costly. Did you know that debt can also provide tax advantages? Yes, it's true. The interest on certain types of debt can be tax deductible, effectively reducing the cost of borrowing. Let's explore this a bit further. When you borrow money for a business investment or to purchase a property, the interest you pay on that loan can often be written off on your taxes. This is known as interest expense deduction. In essence, you're reducing your taxable income, which in turn decreases your tax liability. This, my dear friends, is a smart way to use debt to your advantage. It's like a discount on your borrowed funds, all thanks to the tax code. But remember, not all interest is tax deductible. It's crucial to understand the tax laws and consult with a trusted tax advisor before making any financial moves. In essence, tax advantages are the unsung heroes in the financial world, often overlooked but immensely beneficial. Tax benefits are another reason the wealthy often choose to use debt. Lastly, the wealthy use debt to build their credit profiles. This might seem counterintuitive, but let's delve a little deeper. A credit profile is essentially a report card of your financial responsibility. It's a rating system that lenders use to gauge your reliability when it comes to repaying borrowed money. Now here's where it gets interesting. By taking on debt and paying it off responsibly, you're showing lenders that you're trustworthy. Every on-time payment, every settled loan contributes to your credit standing. And the better your credit standing, the more financial opportunities become available to you. Imagine having access to lower interest rates on loans or being approved for a larger mortgage to invest in real estate. This is what a strong credit profile can do. It's like a golden key, unlocking better loan terms, greater borrowing power, and ultimately more avenues to wealth. Remember, a strong credit profile can open many doors to wealth. So, as we've seen, debt isn't necessarily a bad thing. It's a paradox that can be beneficial if understood and managed properly. We've explored the concept of leverage, how the wealthy use debt not as a burden, but as a springboard to multiply their wealth. We've delved into real estate investments and business expansion, two areas where debt plays a pivotal role, enabling growth and return on investments. We've seen how debt can serve as a tool for investing in the stock market, another avenue for wealth creation. We've also discussed the value of education and skills acquisition, where debt can be an investment in the future. Debt consolidation and the associated tax advantages were covered, demonstrating how smart debt management can lead to savings. Lastly, we discussed the importance of building credit, a critical component of financial health. Remember, the wealthy don't fear debt. They use it to their advantage.